Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the Always Present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome back, everyone, to another Jeep Dive.
Always excited to jump into these with you.
Me too. Today we are tackling Northern Trust's global investment outlook for 2025.
A hefty report this is.
Yeah, it covers a lot. It really does. But that's why we're here.
Yeah.
Right, to break it down.
Exactly. Help folks understand what it all means for them.
All right, so let's start with the U.S. economy. Always a good place to begin. I feel like everyone's kind of holding their breath right now, wondering if we're going to see that soft landing or if things are going to get a little rockier. What does the report say?
Well, they've laid out 3 possible paths they see.
Oh, okay. So a soft landing's still on the table.
It is. That's their base case.
But there's more.
There are 2 other scenarios they've outlined, reflation and supply restraint.
Okay, so remind me. Soft landing means we avoid a recession, but things just cool down a bit.
Right. They're predicting continued growth into 2025, just a bit slower than we saw this year. Consumer spending stays decent, but eases up a bit. Inflation moves towards that 2% target, and the Fed might even start cutting rates. Almost sounds too good to be true, though, doesn't it? Like, there's got to be a catch.
And there is. The big question mark hanging over all of this is the new administration and their policies.
Oh, yeah. The report really digs into that, doesn't it?
It does. Big time. How decisions around things like immigration tariffs, tax cuts, deregulation, all of that could really shake things up.
Yeah, throwing us toward reflation or even those supply chain issues.
Exactly. It's a lot of uncertainty to watch.
For sure. Okay, so soft landing's possible, but not a sure thing. Let's talk about these other scenarios then, starting with reflation. So that's basically inflation coming back to haunt us.
Yeah, that's the gist. If the new administration's policies end up having a stimulative effect, we could see growth above trend for a good chunk of 25.
What?
But the flip side is inflation could surge again, forcing the Fed to hit the brakes on those rate cuts.
Yikes. Not the news anyone wants to hear.
Definitely not. And then there's supply restraint.
Which, if I'm remembering right, that's the real troublemaker. It could be. Imagine tighter immigration policies, higher tariffs. That could lead to major supply chain bottleneck shortages. We could even be looking at a recession by late 25 with the Fed having to slash rates aggressively just to try and get things back on track.
So it sounds like we're walking a tightrope here, and the new administration's policies are the wind that could blow us off.
I like that analogy. A lot riding on those decisions.
Definitely something investors need to keep a very close eye on. All right, so U.S. economy is a bit of a nail-biter. What about the global outlook? Is it just as uncertain?
It is, but in different ways.
Okay, how so?
Well, the report points to a lot of divergence across regions. Like, take Europe, for example. You've got this mixed growth picture. The Eurozone is facing some headwinds, while the UK's outlook is looking more balanced.
Interesting. And what about China? They're such a major player globally, and their economy's been slowing down. What's the report's take on their prospects?
That's where some of the bigger concerns are. The report's flagging that China's growth is sputtering more than expected, and that has ripple effects all over.
So their economic engine's losing steam. What's driving that slowdown?
It's a mix of things. The report points to muted domestic consumption softening manufacturing and exports, and of course the threat of tariffs all adding to the pressure.
Okay. And are they doing anything to try and turn things around?
They are. They've got some policy support measures in place to stimulate the economy, but there's a lot of skepticism about how effective those will be in addressing their deeper structural issues.
So not a lot of confidence that they can fix things quickly. What does the report say about the impact this could have on global markets then?
Well, since China's such a big piece of the global economy, their slowdown's bound to have an impact on other countries, especially those who rely heavily on trade with them. The report's basically saying investors need to be prepared for potential volatility and think about diversifying their portfolios to manage the risks.
Makes sense. So we've got uncertainty in the U.S., mixed signals from Europe, and China slowing down. It's painting a pretty complex picture for investors.
Yeah.
So where does the report see the best opportunities in all of this?
That's where it gets interesting. They dig into specific asset classes, looking at where investors might find potential growth and value. Let's start with U.S. equities.
Okay, the stock market. Everyone wants to know if we're in a bubble, especially when it comes to U.S. large-cap stocks. Are they overvalued? What's the report say?
That's the million-dollar question, isn't it? And they tackle it head-on. They acknowledge that those price-to-earnings ratios, those PE ratios, are high.
Now, for those of us who aren't financial wizards, what does that actually mean?
Think of it this way. A PE ratio tells you how much investors are willing to pay for every dollar of a company's earnings. So a high PE ratio can mean investors are really optimistic about future growth, but it could also be a sign that a stock is overvalued.
So in this case, they're saying U.S. large-cap stocks are pricey. But
they make a pretty compelling argument that strong earnings growth might actually justify those valuations.
So not all doom and gloom. There's still potential for growth in the U.S. stock market.
Potentially, yeah. The report points to a few factors that could drive that earnings growth. Continued economic growth, for one, although at a slower pace. And then there's the potential for expanding profit margins, driven by things like AI, boosting productivity, declining interest rates, and those potential tax cuts we talked about earlier. Plus, analysts are forecasting positive earnings growth over the next couple of years.
So if earnings grow enough, those high valuations might not be as scary as they seem at first glance. But I got to push back a little here. Haven't we seen this before, like the dot-com bubble, for example? Are we just getting caught up in the hype and ignoring the warning signs?
It's a valid concern, and the report acknowledges that. They do point out that the U.S. large-cap market is getting more and more dominated by those tech and communication services companies.
Those big tech giants everyone's talking about.
Exactly. And that concentration does raise some flags about diversification and risk. But they argue that this time it's different. These companies aren't just built on hype. They have strong fundamentals.
So they're actually making money and generating real value.
Exactly. High earnings growth, strong profit margins, significant capital expenditures. They're generating free cash flow. So while their valuations might look high, the report suggests they could be justified, at least for now.
Okay, so U.S. large-cap stocks, even with that heavy tech concentration, might still have room to run.
Yeah.
What about smaller companies? What's the outlook for U.S. small-cap stocks?
They see some potential there, too. Small caps have had more modest returns lately, but the report suggests that declining interest rates could be a tailwind for them, especially for those with a lot of floating rate debt. Lower rates mean lower borrowing costs, which can boost their profits.
Makes sense. And then there's that reshoring trend we keep hearing about, with the companies bringing manufacturing back to the U.S. Could that help small caps too?
Absolutely. The report suggests that small caps could see increased demand if more manufacturing comes back stateside. Plus, they're starting from a point of more reasonable valuations compared to those large caps, which could make them more attractive to investors who are looking for value.
Interesting. So some potential bright spots in the U.S. equity market, but it sounds like investors need to be selective and really understand the risks involved. All right, so we've talked about the U.S. economy being a bit of a wild card, the global outlook full of diverging paths, and we've even explored the potential but also the risks in U.S. equities. What I'm taking away from all this is that careful planning and really understanding the bigger picture is more important than ever.
Couldn't agree more. This isn't the time to be making rash decisions or just chasing the latest trends. Investors need a solid plan that aligns with their risk tolerance and their long-term goals. And that's where understanding different asset classes like fixed income becomes really crucial.
Okay, so let's jump into the world of bonds then. We talked about the possibility of the Fed cutting rates. What does that mean for bond investors?
Well, generally speaking, lower interest rates are good news for bondholders. When rates fall, bond prices tend to rise. But the report goes deeper than that and really breaks down some of the nuances within fixed income. They start by looking at U.S. money markets.
Okay, I'll admit money markets aren't usually the most exciting topic, but I am curious to hear what the report highlights.
You might be surprised. Even though the Fed started cutting rates late last year, money market fund assets actually increased quite a bit.
That seems kind of counterintuitive, doesn't it? You'd think people would pull their money out of those low-yielding money market funds when rates are falling and look for higher returns elsewhere.
You would think so, but historically that's not always how it plays out. The report points out that even in a falling rate environment, money market funds can still be a pretty attractive alternative to other cash management options. It's all about their liquidity and safety.
So even though the returns might be modest, They offer a safe haven for investors who are prioritizing capital preservation and easy access to their funds.
Exactly. It's a stable base for a portfolio, especially when there's so much uncertainty swirling around in other parts of the market.
Makes sense. So money markets have their place even when rates are low. What about other types of bonds? We've heard a lot about inflation lately. Are there any bonds that can help protect against that?
Yes, there are. The report talks about Treasury Inflation-Protected Securities, or TIPS as they're usually called. They're designed specifically to shield your investments from the negative effects of inflation.
Okay, break that down for me. How do TPS actually work?
So their principal value adjusts based on changes in the consumer price index. So if inflation goes up, the principal value of your TPS goes up too. And here's the key. They pay interest on that adjusted principal. So you're not just keeping pace with inflation, you're actually earning a real return on top of it.
So it's like having a built-in inflation hedge within your bond portfolio.
That's a great way to put it. And with all the uncertainty surrounding inflation's path in 2025, the report makes a strong case for including TPS in a diversified portfolio.
Makes sense. Now let's shift gears a bit and talk about investment-grade bonds. Those are generally considered less risky than their high-yield counterparts.
Right, that's right. They're issued by companies with strong credit ratings, meaning they're seen as less likely to default on their debt payments.
So lower risk, but probably lower return too?
Typically, yes. And the report expects these bonds to trade within a fairly tight range in 25, similar to what we saw this year. They suggest that instead of trying to time the market, investors should really focus on security selection and sector allocation within this space.
So being choosy about which specific bonds and industries you're investing in within that investment-grade universe, what areas do they highlight specifically?
They point to a few interesting themes, like companies that are benefiting from the AI boom, they see potential there. On the other hand, they suggest that companies that have been struggling due to weak manufacturing demand might really present some opportunities as those sectors potentially bottom out.
So even in a relatively stable market environment, there are still ways to find value and potentially outperform in investment-grade bonds. Now, for those investors with a little bit more of an appetite for risk, let's talk about the more adventurous side of fixed-income high-yield bonds. What's the outlook there?
Well, the report paints a surprisingly positive picture for high-yield bonds in 25, and they have a few reasons for this optimism. First, corporate fundamentals in the high-yield space are actually quite solid.
When you say solid fundamentals, what exactly are we talking about?
Things like leverage, which basically measures how much debt a company has relative to its assets. Right now, leverage in the high-yield space is below its historical average, which suggests that these companies aren't over-leveraged. Also, their interest coverage ratios are healthy, meaning they're generating enough earnings to cover their interest expenses comfortably.
So they're not drowning in debt and they can actually service their debt obligations. That's reassuring.
Exactly. And that translates to lower default rates, which is always good news for bondholders. The report also highlights that the technical picture is supportive for high-yield bonds.
Okay, time for another quick explainer. What does technical picture mean in this context?
Basically, it's all about the supply and demand dynamics in the market for high-yield bonds. And right now, they're seeing favorable conditions with healthy demand from investors outpacing the supply of new bonds. That can push prices up.
You know, of course, we can't talk about high-yield bonds without mentioning the yield. That's usually the main draw for investors.
Right. And the report mentions a starting yield of over 7% for high-yield bonds, which is pretty attractive in today's environment. They do acknowledge that credit spreads are tight.
And just to clarify for our listeners, credit spreads refer to the difference in yield between those high-yield bonds and safer government bonds. So tight credit spreads mean investors aren't demanding as much extra yield to compensate for that higher risk.
Exactly. And while those spreads could widen, the report believes that any widening would be manageable, especially given that high starting yield. Overall, they see high-yield bonds as a potential source of total return with less volatility compared to some other riskier assets.
So a potentially rewarding option for those who are seeking those higher yields, but are prepared to handle some ups and downs along the way. Now, the report doesn't stop there. It also looks at securitized bonds, specifically mortgage-backed securities. Those haven't always had the best reputation, have they?
They haven't. The 2008 financial crisis is still fresh in a lot of people's minds, and mortgage-backed securities played a big role in that. But the report points out that these securities have gone through some major changes since then and might actually offer some value right now.
Okay, so what are they seeing that suggests these securities might be worth considering?
Well, they're pointing to the fact that mortgage-backed security spreads are wider than they typically would be.
Meaning the difference in yield between these securities and safer treasury bonds is higher than usual.
Right, and that's partly because they're pricing in a higher level of volatility. But here's the interesting part. The report expects that volatility to decline as the Fed continues to cut rates.
So if volatility goes down and investors get more comfortable with these securities, those spreads could tighten, potentially leading to some nice price appreciation for investors.
Exactly. And there's some other factors working in their favor too, like prepayment risk, which is the risk that homeowners will refinance their mortgages and pay off their loans early. That's currently very low. This makes those securities more predictable and more attractive to investors. They also highlight the potential for increased demand from banks, which could further boost prices.
Okay, so even with their somewhat rocky past, mortgage-backed securities might be a compelling opportunity in 25. We've covered a lot of ground in the fixed income world, but there's still more to explore. What about municipal bonds? Just for those who might not be familiar, these are bonds issued by state and local governments.
Right, that's right. And the report has a positive outlook for munis as well. They cite strong fundamentals, attractive starting yields, and healthy demand from investors who are looking for that tax-free income.
Ah, yes, the tax-free part. That's a big draw for a lot of investors, especially if the new administration extends those tax cuts, like the report suggests they might.
Absolutely. Extending tax cuts would make munis even more appealing compared to taxable investments. They do acknowledge that credit spreads are tight, but they don't see any major factors that would cause them to widen significantly. Overall, they think munis are well-positioned for 25.
We've really gone deep into the world of fixed income here. It seems like there are potential opportunities across the board, from the stability of money markets to the higher yields of high-yield bonds and the tax advantages of munis. But the report doesn't stop there. It also covers alternative investments, which can be a whole other ballgame. Should we take a look at those?
Definitely. Alternative investments are a crucial part of the conversation, especially when we're talking about diversifying a portfolio and potentially boosting returns.
Okay, so let's start with real assets. What falls under that umbrella?
Real assets are tangible assets, things you can actually touch, like real estate infrastructure, natural resources. And the report suggests they're particularly well-suited for 25, especially in a declining interest rate environment.
That makes sense. Lower borrowing costs should make it easier to finance those big real estate projects and infrastructure investments.
Precisely. And they go deeper than that. They highlight some specific areas that look particularly attractive, like data centers, which are benefiting from the explosion of data, and the rise of AI industrial real estate is another one they like, driven by the growth of e-commerce and the need for more logistics and warehousing space. They also point to healthcare, which benefits from those long-term demographic trends, and residential real estate, where there's just a constant shortage of housing in many markets.
So no shortage of opportunities within real assets. What about infrastructure? That seems like a pretty solid investment.
Literally. Right. It's not just about roads and bridges anymore. The report points to the growing demand for power infrastructure, especially with all the energy needs of data centers and AI. They also like its bond-like characteristics, which can be helpful in a falling rate environment.
And then there's the sustainability angle. Investing in renewable energy infrastructure, for example, can align with an investor's values while also potentially generating good returns.
Exactly. That's a trend that's only going to gain momentum. And then there are natural resources which haven't performed as well this year, but the report still sees them as a decent hedge against geopolitical risk and inflation.
Okay, so real assets offer a mix of diversification, potential growth, and inflation protection. What about hedge funds? Those are often seen as the realm of sophisticated investors.
They are. And for good reason. They can be complex and they tend to have higher fees than traditional investments, but the report argues that they can play a valuable role in a well-diversified portfolio, especially in uncertain times like these.
What makes them so well suited for navigating uncertainty in the markets?
Their flexibility. Hedge funds can use a wide range of strategies that aim to generate returns, whether the market goes up, down, or sideways. Some of the strategies they highlight that might be particularly effective in 25 include equity hedges, event-driven macro, and relative value.
So hedge funds bring flexibility and the potential to weather different market conditions. What about private credit? That's an area we've been hearing more about lately.
It's definitely become a popular alternative investment, and a report suggests it still has room to run. They see private credit as a key beneficiary of the expected increase in M&A activity, especially as private equity firms start deploying all that cash they've been holding on to.
So these private credit funds are stepping in to provide financing for those deals, filling the gap left by banks who have pulled back from some areas of lending.
Right. And they often focus on that lower middle market lending to companies that might not be able to get traditional bank financing. The report really emphasizes the downside protection that a lot of private credit investments offer, which makes them attractive to investors who want higher yields but are also concerned about preserving their capital.
What are some of the features that provide that downside protection?
Things like seniority in the capital structure, meaning those private credit investors get paid back before other creditors if a company goes bankrupt. They often have financial covenants in place too, which gives them some control over what the borrower can and can't do. And a lot of these private credit funds have very experienced teams who actively manage their portfolios and work closely with borrowers to help them succeed.
So while there's always some risk involved with private credit, there are structures in place to help mitigate that. Finally, let's touch on private equity, which has faced some headwinds lately. Does the report see any light at the end of the tunnel for this asset class?
They do. They're expecting the exit environment to improve as interest rates decline. This would allow those private equity firms to sell their portfolio companies at better valuations and generate returns for their investors. They also see some attractive valuations in the private market, especially compared to the public market, where valuations have gotten a bit stretched in some areas.
So there's potential for private equity to outperform public equities again.
It's certainly possible, and they highlight the role of the secondary market in providing liquidity and creating opportunities for investors. The secondary market allows investors to buy and sell existing private equity investments, which can be a way to get exposure to this asset class without having to commit to a long-term fund.
We've covered an incredible amount of ground today. From the global economic outlook to U.S. equities, bonds, and now alternative investments, this report is packed with insights. But it's a lot to digest. What are your main takeaways from all of this?
I think what stands out most to me is the emphasis on careful planning and strategic asset allocation. This isn't a time to just chase the hottest trends. Investors need to have a well-thought-out plan that aligns with their risk tolerance and long-term goals.
You're absolutely right. And it's clear that there's no one-size-fits-all approach. There are potential opportunities across all sorts of asset classes, but investors need to do their homework, understand the risks involved, and make choices that are right for them.
Yeah, it really drives home the point that you can't just be picking investments randomly. It's about being strategic with your asset allocation.
Exactly.
Yeah.
Not just throwing darts at a board and hoping for the best.
Then you gotta have a plan.
You do. It's about spreading your investments across those different asset classes in a way that manages risk, but also has the potential to really enhance your returns. It's like putting a puzzle together. Each piece has a specific role to play in creating the bigger picture.
And it sounds like Northern Trust, with all their expertise and insights, can be a great partner in that process. Absolutely. This report is just a starting point. They have a whole wealth of resources to help investors navigate this landscape.
Okay, so for our listeners who are ready to take action, where do they start? What would you recommend?
First step's easy. Head over to Northern Trust's website. Seriously, they've got a ton of resources there. More in-depth reports, articles, interactive tools that can really dive deep into specific investment strategies.
So it's like an extension of this deep dive, but even more tailored to your specific needs.
Exactly.
Yeah.
You can explore their different investment capabilities, learn about their approach, and see what solutions might align best with your goals and how much risk you're comfortable taking.
And if you're looking for more personalized guidance,
they have a whole team of experts who can work with you one-on-one to develop a truly customized investment plan. One that takes your specific circumstances and goals into account.
So whether you're a seasoned investor or just starting out, they've got something for you.
They do. And finally, I'd say take some time for self-reflection. Think about your own investment goals, your time horizon, your financial needs. How much risk are you truly comfortable taking?
It's about making sure your investment strategy matches your personal situation and your overall financial plan.
Exactly. And don't be afraid to ask questions, whether it's reaching out to Northern Trust's team, talking to your own financial advisor, or just doing your own research. Getting clarity on these things is so important.
It all comes down to being informed and feeling empowered as an investor. And I think this deep dive has definitely given us a lot of information to help us do just that.
I agree. It's been a fascinating look at the global investment landscape, the big trends that are shaping the markets, and the things investors really need to be considering as they make their decisions.
Yeah, huge thanks to Northern Trust for putting together such a thorough and insightful report. It's given us a lot to think about.
It has. And as we head into 25 and beyond, it's crucial to stay informed. Keep an eye on those developments we've discussed, and be ready to adapt our strategies when needed. This investment landscape, it's constantly changing, but with the right knowledge and guidance, we can navigate it successfully.
Well said. To our listeners, thank you so much for joining us on this deep dive into the global investment outlook for 2025. We hope you found it as insightful as we did.
And remember, knowledge is power. Keep learning, stay curious, and make those investment decisions count.
Until next time, happy investing.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.